Well, we'll get her going anyway.
Don't mind.
Guys, a few tech issues. Sorry about that.
I'm gonna come over here in case they have questions, Mike.
Okay, perfect. As mentioned, Mike Fleming, Bank Montreal, Andrew Gibson, both mortgage specialists at BMO. I've been RBC a couple of years, BMO about 6 years now, so back and forth. Andrew, you've been what now? 15, 16?
15 at BMO. Yeah. 15.
So a lot of experience here in doing mortgages, and really what we want today to be is kind of an open session. We'll go through some things that we believe that are kind of affecting your guys' world a little bit right now. To be some probably good nuggets here that you guys will take away. Anytime you have any questions throughout it, we might bring something up here now, you're like, oh my God, my client's going with that right now. Ask us a specific question right now. You don't have to wait till the end, just stop us. It'll be totally just a back and forth session, interactive session as we go through it. Biggest thing I always want to mention, we always want to talk about is how can we help you in your business? That's what we're here to do. We're an extension of you guys. We're an arm, another one of your affiliates ideally that you work with. So you have your financing people, you have obviously your lawyers, your inspectors, accountants, financial people that you work with. So big thing for us, pre-approvals, they're so important now. Get your pre-approvals done, quick turnaround on approvals as well. One thing I wanted to mention, I'll go into when I talk about pre-approvals, is get the pre-approval done, because that's where all the hard work is, right? The biggest issues we have is income, obviously debt servicing and credit. So any issues that we have, let's just get that dealt with first. And plus it also saves the rate. Then once you have a live deal, we can get that off in credit, it's approved within 24 hours, ideally. Or if an appraisal is needed, maybe 3 or 4 days, depends how long an appraisal is gonna take. But open communication about approval and instructions timing. Timing is critical, especially in this market right now. We're obviously not getting extensions as much as we used to. Things are a little bit more challenging, obviously, over the last, especially year and a half. So, my goal is to have an open, honest communication with you, whether it's text, refer, email, phone calls. Just please understand that's how we operate. We don't go dark. We don't just say, you're not gonna have to email us and say, where's the financing letter? We're gonna get that to you guys as soon as we possibly can. Giving you guys a great customer experience, giving your clients, obviously, which in turn reflects on you as well. So, as I mentioned when I first started, we are an arm of you guys. So if you refer a deal to us, chances are we're gonna get one crack at it. And if we totally mess it up, we screw up on, could be anything from communication, whatever it might be, bottom line, your client's not happy, you're not gonna refer to us again. We're 100% commissioned employees, same as you guys. So you do have people within the bank that are salaried, that also do mortgage as well. But we are 100%. We're not 9 to 5. We're literally almost 24/7. We do sleep a couple hours, but same as you guys. We're on the same schedule as you guys, right? Weekends, whatever you need. So please reach out. We get the tough ones done. And I've dealt with, I know Angela's on here, Maureen. We love the easy ones, as I mentioned too. But I'll say one thing about our policies and our process. I'm going to say that it's a little more lenient, but our policies will be a little more lenient, I think, than other lenders, and we can get some of the deals done that other lenders can't. There's nothing that makes me happier if I can save essentially your commission, it's commission for us as well, to be honest, and it builds that relationship for us, right? If you come to me and say, whoever can get the deal done and we get it done, I love that. That's my favorite thing to do in this job, to be honest, is saving and resurrecting a deal. I love it. And like I said, available 24/7. So any questions that you guys or your clients may have, I'm talking with them literally until 10 o'clock at night, whenever. As you guys know, they're working, let's say 9 to 5. We're dealing with all their questions and everything when they get back from work. And your emails, second round of emails start to come in from like 6 to 9 o'clock. So we're dealing with them there. The benefits I mentioned of getting pre-approved, don't need to go down this hole too long, but just get this done, especially now in a rate increasing environment. So biggest thing, save the rate and get the heavy lifting done up front. Obviously, you guys are going to need in this market, make sure your deal or your offer is stronger, have an approval letter. So we have kind of our pre-approvals. If it's a pretty, what we call slam dunk pre-approval, we'll have an automatic approval process where it actually doesn't have to go to a credit officer. So say income is very clean, credit's clean, debt service is in line. One of the unicorn clients we call it, if we do have one of those, it'll automatically not have to go to credit and we can send the approval letter right away. If there are some things we need to mitigate debt servicing, maybe there's a few credit blips on there that we need to get around, it will have to go to credit and we'll send it to credit that day. Usually about 24 to 48 hour turnaround on pre-approvals, depends how busy credit is. We are the only lender that'll do 130-day rate hold. Very important. Many lenders will do anywhere from 90 to 120. We will do 130, that extra 10 days can mean 10 and 15 points in this market, because we're essentially seeing rates going up every week, I'd say, right? We get an email. We get 24 hours advance notice that they're going up, so we try to get our pre-approvals in to save the rate. But yeah, so that extra 10 days is big, and even 40 days versus some brokers. So it all depends. So make sure your clients are asking how long that rate hold is. And we do, as far as I know, have the longest rate hold in the market at 130 days. Also, as mentioned, to have that pre-approval in place quicker. So essentially, you might have a deal that you might say, Mike, can we do 5 days financing, right? So we can make your deal a little more attractive. We can probably do that if we have that pre-approval in place. Because like I said, all the hard stuff's done, right? So I do a pre-approval last week for you guys. You give me the purchase and sale on Monday morning. It's going to credit Monday and probably approved Tuesday, right? So it's either going to be approved Tuesday subject to appraisal, which hopefully we can get appraisal done really quick. 3 years ago, I'd order an appraisal on a Monday and I'd get it back on a Thursday. Now appraisals are taking a little bit longer, unfortunately. So we're kind of a waiting game sometimes. Sometimes it's up to a week. So my hands are kind of tied at that point, dealing with NAS on that. It's not fun, but we can get the approval pretty quick and just let you know what they can afford. So with pre-approvals, you can obviously in a competitive market like this, you're going to want to know what the max. So they might say, Mike, I want to be a pre-approved for 400. I'm going to let them know they can go to 550, right? As long as they have enough down payment for it, that servicing works and everything. Just so it doesn't mean they have to go to 550, but at least they know that they can, and you guys know that they can. Okay. Any questions on pre-approvals?
I have a quick question on your approval letter that you'll provide. Will you change the amount on it to match what the client wants to offer? It's lower than their pre-approved? Because I've come across one who's financing person will not change that amount. So if they're offering under what their max is, you send it out.
So a lot of them are filling them out now, basically.
Yeah.
If they're putting an offering for, let's say, $300,000 and they have a $400,000 budget from the bank, they'll just say they're pre-approved so that they don't know that they have an extra $100,000.
So
it comes back into
I don't know how you do
I know
it.
exactly what you're
Condense
saying.
what I'm-
Yeah,
Yeah.
absolutely.
So what I normally do, whether it's right or wrong, is I'll say here's the max they can go to.
Right.
Right. So
How hard is it, or
and then we have
would you
conditions
change
on
the
it.
letter?
So we can easily change.
Create a letter
Yep.
that says 300, not 400?
Yep.
Just.
You come back and say, you call us and say, listen, can you put, I know the max is 5, but can you write it as 4? It's gonna help my negotiation.
Yeah.
I have a letter that I will input the amount.
Okay.
Change it up.
If that's what you guys want, for sure, we can easily do that.
Now, and then we have a standardized one that gives all the details of the mortgage, dollar amount, rate, payment. We'll send directly to the client
Right.
for their own records, so they know that they're formally pre-approved. But if you want something ready and signed for your negotiation purposes, for sure.
So no secret here, I'll always harp on this one. It's a great program that we have, banking, official banking partner of the defense community. So when I speak about defense community, like this is military, Navy, RCMP, Coast Guard. So essentially it's also retired as well. So you have, this is a deal for a client that is with Halifax Police, for example. He was 4 years with military, so now he gets all our military specials. Previously our military. So essentially what this means, obviously they get discounted rates. We're kind of anywhere in that. I've seen as high as 20 points lower. I've seen as low as 10 points lower. It's usually in that kind of 10 to 15 points lower than most lenders out there. The big thing that we do on this is covering penalties, right? So you have a client that's in Halifax getting transferred to Borden, Ontario, for example. They're selling their place. They have an $8,000 penalty. We'll look at both options. Does porting make sense for them? Or does breaking, it depends what the rate situation is at the time, or does breaking the mortgage make sense? And then we pay the penalty and they start a new fresh term. Right now, probably porting makes sense because they probably started a couple of years ago, might have a rate of 2.1 or whatever it might be, and now rates are almost double that. So porting would make sense, but previously a couple of years ago where rates were decreasing, then it made sense to break the penalty. So that's one thing that Brookfield or PGRS does not cover anymore, penalties, so we cover that for your clients. You used to have a $5,000 max, now there's no max on it. So any questions on the penalties that we covered? Okay. And then just an overall offering, I won't spend too much time on this, but as I said, mortgages, it's same, the 130-day rate guarantee, lower mortgage rates. We We have Supporter Troops MasterCard, free banking as well, right? Banking fees, it seems every year, what, $1, $1.50. Right now they're creeping up into $17.95 and around there.
That's crazy.
Right? It's nuts. It used to be $13.95 a couple of years ago, it seems. So that continues to creep up. So that makes a difference as well, right? Because I don't do the everyday banking side, our personal bankers do. So I'll introduce your clients to our best personal bankers that we have at each branch. But essentially, you get free banking, you get discounted line of credit rates, discounted mortgage rates, no annual fees, Supporter Troops MasterCard. So it's a really good overall program for these clients. Any questions on that? And these are just the buyer sheets. So if you have any clients that they're not rate specific, but if you have any clients that are with, like I said, military, RCMP, whatever within the defense community, I can get these tailored up for you as well. And it just goes about mortgages saying, here's what we offer. Like I said, it won't be rate specific, but I'll let you know what the rates are at that time, okay? And then also what our bank accounts offer, kind of the whole overall offer that you can just say, here's a contact, Mike or Andrew at BMO, and where you guys are military. I think it's really good to have a second conversation with them, right? So it doesn't hurt.
I have one coming next week. I'm not sure who she said she's pre-approved, but I will make
Yeah.
sure that I.
For sure, that would be amazing. Yeah.
Yeah.
Because essentially we'll compare apples to apples. Now, the hard part might be if they're pre-approved, let's say 2 months ago, rates were much lower 2 months ago. If we were pre-approved against, let's say it was TD, I'm just using your example right now, we'd probably be 15 points lower than now. I'm just guessing right now as of today. But if they did the pre-approval 2 months ago, they might have 2.99 or 3.2 or something like that. So I wouldn't be able to compete with that. But it just depends. Yeah, how long ago did they get the pre-approval? When does it expire? Right, that's the big thing, right? So if they're pre-approval with whatever lender is only 90 days, it's only another 30 days left on it. You're probably not going to get something in 30 days. It wouldn't hurt to have a pre-approval with us as well, just because we'll do another 130 days out for them.
And the budget may only be for a mini home, so you guys do videos.
Yeah, for sure. And we'll get there on that.
Okay, perfect.
Investing for your future. So, was there any more questions on the military? Investing for your future. So essentially we'll look at vacation homes or second homes and investment properties. So a big misconception out there that people, if you want to buy, let's say a cottage, second home, you need 20%. That's not the case. If you have an owner occupied home and you want to buy, let's say a cottage or another second home, you can do that with less than 20% down. You can do it as little as 5% down technically, as long as the property meets the criteria. And criteria is as simple as we do it through the default insurer called Sagent. And they call it property A or property B. Like a property A at 5% down has to have, potable water, year-round heat source, year-round access to the property, things like that. 10% down might be a seasonal property. So investment properties, a few things I want to touch on here. Investment properties are going to be 20% down if we're buying it as an investment property. Maximum we can do is 4 units. And the big thing, this is when I said BMO's going to few more lenient policies. This will be one of them too. Rental income calculation can be applied to investment units, not subject to financing for service mitigation. So what essentially that means in layman's terms is we do what's called a rental offset. So if the client's looking to, let's say, buy a new owner-occupied home, for example, okay? Then we can take the existing home, we'll get a market rent on it. So let's say their home that they're currently living in is going to rent for $2,000. Then we just take $2,000, we have to minus a vacancy rate on it of 15%, which is arguable because there's really no vacancy rate here now, but we do have these 15% minus the principal, interest, taxes, and heat. And it usually spits out to a net wash or an even number. So it's almost like that property doesn't exist in our world, right? So it is one way that I do with a lot of clients, if they want to increase the amount of properties that they're getting, they can do 5% down, is they'll rent out their existing, move into an owner-occupied home at 5% down. We do the rental offset calculation on their existing home. So really, it's just their household income that's going towards whatever liabilities they have, right? It could be car payments, student payments, whatever it might be, credit card, line of credits, and the new mortgage payment, right? So just almost pretend like that other rental doesn't exist. So let's say they had 2 or 3 rentals. We can do rental offsets on all of those, right? So it's almost like those 3 rentals don't exist. You know what I mean? So it's a really, really incredible program for us to get debt servicing in line for clients that are looking to buy 1, 2, 3 additional properties or have 3 or 4 additional properties. I believe the max that we can do is 5, right, Andrew? Max on 5 rentals.
Max we can finance is 5 rentals.
Yeah. So once it gets over that, then it gets into the commercial space for us. You become a real estate operator. But yeah, that's one trick that we do. So like I said, 20% down for investment property. Sure.
Sorry, the people on the waiting room.
Oh.
Oh, is there?
Yeah,
Yeah,
Aaron just
because
sent
we've
me a
got the
message.
PowerPoint, we haven't been able to do both, so.
Yeah, let me just,
To get this working.
I know, I don't know why it's,
Oh, goodness, not.
I don't know if you guys see that.
Yeah,
We're seeing that
usually I
here,
can
but
see
we're
that
fine.
well.
So actually
We do
move
the
everything
presentation
slide
and
you
take any
home,
questions,
Owner
but-
occupied, and you're doing it
Can I
less
turn
than
it
20%
off?
down. If it's owner occupied, so you're doing it 5% down. And renting out your existing
I'm gonna
place.
take off the waiting
Let's
room.
say you bought a place 5% down 2 years ago.
I didn't
Now
even
you're renting
realize
out, moving
that.
your new one, 5% down. You get
That's
2%.
why I sat here in case, but I can't see the Zoom.
I know.
The rental offset on that other property.
Wait a minute.
I think this might work now.
This might work. There's the screen
You see
we're
live
on
too,
now.
huh?
Which screen are we on now? We're on,
Because everybody always
This
thinks the
one.
how
So
it's
they
going up,
should,
like,
so can they see that?
Right,
Live in the
exactly.
next one and right your other one.
share, just share and see if they can see it. Uh-huh.
There we go.
Yeah, but
Oh.
we're not on the same slide, but we can go down to that slide over here.
What one is it?
What slide
Oh,
number?
you wanna be close, that'll mess it up.
Why do you think
I'll
I'm
still do a
standing?
little Timbit break.
Standing over here for a reason.
I'll click for you, Mike, and then that way, hopefully we can get this.
It was a good prayer.
If you go down here,
It's not letting me click anything.
click the bar.
Yeah.
No.
Goes through you, and I said, well,
How's your food, huh?
I started eating everything. And that's not working for me.
You
So
click
that's
on
not how-
5 and see what happens. Just click on that
Whatever.
slide.
Does that work with drinking too?
That's right.
No,
Everything.
resume slideshow.
Yeah.
Wish I had
This
my
computer's also very, very
It is
slow.
computer.
It is literally kind of the worst.
Like my computer.
Yeah, it's,
I was saying, I don't even like Boston Greens, but I go to the Tim Hortons.
So now we're on that now.
Every now and then Boston cream.
I
And
agree,
they
I
have
agree.
upped the
Like once a
cream,
year I get a Boston cream.
but they've upped
Me
the
too.
cream in the
Oh.
Boston cream.
Oh, are they good now?
Oh, they are.
I don't often eat donuts.
Okay, I went to Tim Hortons for a donut last week, and I don't go to Tim Hortons for a donut.
So I was
And
there
I've
this
been
morning,
twice.
I was there this morning and I love the Cadbury mini eggs.
Yes.
Mini eggs is
Oh.
my favorite type of chocolate.
Yeah.
And they have one now with
I don't-
crushed up
oh,
mini
yes,
eggs
I
around the
know.
top, and then in the center of the hole, there's like 4 or 5 mini eggs in it.
I bought a big bag because my little nephew was coming Easter and he wanted them.
Yeah.
And then my nephew messages me and said, we can't come for dinner anymore. And I said, well, that's probably a good thing because Keith and I have eaten all the day. So now I don't have to go buy more.
Apparently, if you put those in the freezer.
Oh,
they're
don't even talk,
better.
don't make
Because
me
the
want
way
them more.
They
Yeah,
crack and the way they, anyway, you're
Hide
welcome.
them in the freezer.
Yeah, I don't know that I can hide that kind of stuff.
One from the other.
If you eat it from love, remember? It's
That's right.
That's right.
You eat it from love.
it shows that we're sharing.
It shows that we're sharing, but now that's up there where it was the Zoom. Isn't that funny?
Right. Technology.
You had it.
Stop the share and then bring it back.
And yet we have another.
And is it that? Is it, or is it that? Which one is it? That one? Maybe that one. Which screen are we sharing? Okay, so here I can see the Zoom there. Can they
Yeah.
see this? Hello, people out there in the atmosphere. Can you see that? It should be sharing now.
Yeah.
I can see you investing for your future.
Perfect.
Perfect.
Thank you.
So, yes, and that's what we're on, right?
Yeah.
Okay.
So they can see this now?
They can see this now. Tell
Okay.
me when you want me to click next and I'll click next.
Do you guys,
If I can get down.
yeah.
We can go to the next.
So you guys have any
Oh,
questions
so
about
not
rental
driving
properties
again?
or what we can do? Okay, cool. So we're ready for the next one there if you guys want it.
If we can.
Oh,
Just a second, just a second.
there.
we go. 9? Did it work?
Enter should. So I see it on your screen there, but it's not going up there.
Yeah.
Oh my gosh.
Oh, my land. Resume slideshow? Oh my heavens, so that's not showing now. Isn't that weird?
As I said, as
It's-
soon as
it
they get close,
shows.
as soon as they get over there.
But on there
Walk
it's
away,
Oh,
go
yeah.
another donut.
Go back to the
not. We are experiencing technical.
I can say
Oh my gosh.
This is our first time back in the field, so.
And we have a chat.
I don't get that
Have
much.
patience.
Click on it.
No worry about that.
It's nice to see
Can they click
though. When we took the masks off, and I walked into Costco and everyone has their masks on. I went up to the lady and said, can I take my mask off? She's like, yes, it's okay. And every person I saw was, it's so nice to see you.
Even though they don't have their mask on, they're still saying.
Yeah. Oh, yeah, it's not. It's nice to see your
It's,
face.
do we have a bunch of windows open with that same presentation? Is this what's messing us up?
Yeah. Oh, yeah, no idea.
Maybe.
It's the kids, right?
Yeah.
The kids. And unfortunately, I don't know if you know this, the last place that.
So what if now,
The eyes.
there it
So
is.
in masks. the last
Okay, so
place
this
that
is
we
what we
know.
need.
This is what we need. I think we had a bunch of ones. So this is what, okay, so now we're on purchase plus improvements. So is there a way that I can just click through them? Now they can see that, right?
Yeah. And then, yeah, because
If I
here's
could-
your Zoom,
Yeah,
and then you should just be able to do that.
yes,
Yes,
okay, there we go. I think we're good. Mike?
Okay.
We're back.
Okay,
I know.
just tell me when you want me to go to next.
Can you guys see that on Zoom?
Yeah, they apparently,
Think of like a thumbs up or something?
Thank you.
Zoomers, can you see?
Yes, we can.
Thank
Okay,
you,
perfect.
Angela.
Great. So I think this is my last slide, and Andrew's gonna hit a couple slides for you guys as well. Do you guys see, I don't see a lot of purchase plus improvements going on right now. We do a lot of those. So this is a program that's offered by all default insurers, CMHC, Sage, and Canada Guarantee. So this is essentially the clients, let's say, buying a home, 5% down or 10 or 15, less than 20% down, right? We can do purchase plus, but essentially the renovations can't. It's going to be either the lower of the 40,000 or the 20% of the purchase price. So essentially, we just need all the quotes up front, right? So if a client, let's say they're purchasing a home for $300,000, right? We can go $40,000 on the improvements. That's the lower. Just get the quotes up front. Could be a new roof, could be oil tank, whatever it might need as you go through. Some things that are found in the inspection, for example, we can add that in. Normally, it's more cosmetic stuff versus structural, right? We can add that in, and essentially, yeah, it's one draw at the end, and then we will hold back on that, and then we'll send that to the lawyer and pay the clients back after they pay for the renos. We can also do this conventionally as well. So let's say a client is buying 20% down home, so the default insurance is not involved. Then we can do also a single holdback, but a max of 20,000 or 10%, whichever's lower. Yeah. So the max we can do is 20 on this. Our other option is then it goes into a construction draw, and we'll get into that in a few minutes. But let's say you have a client buying a home for $300,000, and they want to do $300,000 or $400,000 in reno. So it's a full-on restructure of the home. Then we can do that, but that's going to turn into a construction progress draw mortgage, not purchase plus. So it changes a little bit, and Andrew can touch on that in a minute. But any questions on purchase plus?
So can you, it's hard to get quotes now, as you know, because trades. So can you just take a rough quote? So if we had a renovation person in our back pocket that could give a rough quote, but then later they could check
As long-
around to see if they could get
The
a
big
better
thing we always
deal.
say, as long as the scope of the work stays the same.
Yeah,
So if you give me a quote for 35,000 saying you're gonna do X, Y, and Z, but then you change it to 3 different, right, A, B, C, whatever it might be, then that's gonna pose a challenge, right? But if it's essentially gonna be roughly the same price, and it's all the same work, but the contractor changes, that's not gonna be an issue on our end. As long as CMHC is approving it based on the work that's being done, so whatever flooring is going in, or kitchen cabinets, or, because a lot of clients will say, well, I mean, I saved 10,000 on my kitchen, can I split it in that? So technically we can't, we're gonna hold that money back, we can't just give that to them, unfortunately. So the program is specifically designed for to have whatever quote's done, that exact work's done, we pay that exact contractor. But if the contractor changes, not a problem.
okay,
You just keep the work the same, yeah.
all right.
And next one.
Oh, wait a minute.
Oh,
Did we, wait a minute.
We got this.
There it is.
Even if that,
This-
even
this
if
is the
that
next one,
works,
isn't
we
it?
can,
Mobiles,
go back up one, let me see, go to 9, what was 9?
I think was purchase plus.
Okay, yeah, so go down to the next one. So here's the last one I'll touch on, then Andrew can go at it. But, I mean, I know RBC had a stranglehold in this market over the last years I've been in the business anyway. But we started doing mobiles in the last year, so competitive pricing with RBC, same as your 5-year conventional rates. We do it in leased land, which is mobile parks, or on your own land, whether it's permanent foundation or non-permanent foundation. The clip loans, what we call, so if you're actually in a park, you can actually pay that off without penalty. So that's kind of advantage to that. Now this is subject to BMO and CMHC approval. So I'll do a pre-approval for your client, but what we have to do, and what's really gonna help me for this is you guys tell me what you think the property taxes are and what also the park fees are gonna be, right? It's gonna be 300, 275, 400, whatever those are gonna be, because I gotta factor that into my debt servicing as well, right? So that's gonna actually reduce the amount I can do on a mobile slightly, because there's a few more fees in there. So yeah, if you guys want a very accurate pre-approval, just send me that exact information and we can do that. But just want to let you guys know that we do play in the mobile space.
Okay, that's good.
It doesn't look like we're sharing our screen anymore.
No? Okay. Well, it
It
says,
says you are sharing.
Yeah, we're sharing.
Yes, we are.
Oh, okay, never mind. We're all working together.
Just not on the,
So-
just not on the slideshow version, I guess.
So one thing I'll say here, this is a competitive advantage that we have that no one else can do. We have a product called an MHL, which is a mobile home loan. So this is like a conventional deal. It's not CMHC insured. So we can do this on mobile parks or on your own land. So max loan to value is 75%. So 25% down is needed on this one, and it's subject to satisfactory appraisal. So we have clients, let's say they don't meet CMHC criteria. Let's say they don't want to pay CMHC fees and they have the 25% down, maybe from a sale of home or family gift, whatever it might be. We can do it at 25% down, taking CMHC out of it. Another thing we can also do, we're doing a few of these as well, is refining a mobile, right? So a lot of clients always ask me the last 7 or 8 years, can I refi a mobile? Like, you can't. So now we have a product that we can. So it's under the same product, MHL. Let's say a mobile is worth $200,000, take 75% of that, which is gonna be what, 150,000? So we could lend 150,000, let's say they owe 60,000, now they have $90,000 of equity that we can pull out. Maybe they wanna do whatever, buy another property, whatever it might be. But we can pull equity out of mobiles, and we know mobiles have gone crazy over the last couple of years as well.
oh
So
my
there's
God.
a lot of
it's
people
not
with
nuts.
buying them at 90 grand 3 or 4 years ago, and now they're 200 something. So there's a lot of equity in there if people want to consolidate debt, things like that. And chances are, if they're with RBC from 2 or 3 years ago, I believe when I was with there, they wouldn't have a penalty to get out of that as well. So they don't have a penalty getting out of it. Now they're going to have to check. Don't quote me on that 100%, but I don't believe they have a penalty getting out. So max amortization for that is 15 years. On a new mobile, for example, we can do 20. But on the existing ones I do in parks, they're going to be 15 years amortization, very competitive rates on it. So that's just a program that we offer that other lenders don't. So do you have any clients with
Good to
mobiles? Yeah.
When did that happen?
So when did we start getting into the clip and MHL game with?
So,
Well, we've always had it, but we got more aggressive on rates.
Yeah.
We've always had it, but we were always like 6.5%.
Yeah.
RBC would be like 2%. It just didn't, clients
Yeah.
wouldn't go to us, obviously. But now essentially the product, it's been here for a long time for us. But now we're aggressively priced. So it makes sense for clients to at least compare us to RBC for that, yeah. I'll let Andrew get into this because kind of land financing and construction mortgages. But do you guys have any questions on the mobiles or MHLs, anything like that? Good, okay.
all right. So we are one of the few lenders in the market that finance land. And we're actually one of the lenders that, probably the most aggressive lender in financing land from what I've experienced. So down payment wise, typically the average down payment on land is 35% down. There are some unique scenarios where we've actually financed land purchases at 20% down. Okay, so those, to give you an example, would be something that would be maybe a highly marketable city lot, like an urban lot, or maybe like a waterfront lot that might be maybe like sort of the market, like Chester or something like that, and with be like overall what we call like a strong covenant strong borrower, higher net worth borrower. So we do up to that, but on average, it's 35% down. From what I've seen in the marketplace, some lenders cap it at 50% down. That's what I've seen. It's subject to an appraisal. So in every land purchase, we always get an appraisal done to confirm the value of the land. I usually don't see a lot of issues with land, appraised values of land, just because it's so hard to come by. One of the unique features that we have at BMO that I know some lenders do not is we don't have a requirement for the borrower to start to build on the land within a certain time frame. So I know some lenders will only do it if there's maybe like a contract that's falling behind that. For whatever reason that might be, for their own security. We don't. The client can sit on it for 10 years if they want to sit on it for 10 years. And the type of financing that we typically do on a land purchase, it's essentially a collateral mortgage. So it's a mortgage, collateral mortgage, not a conventional, that is secured against the land that we can amortize up to a maximum of 25 years. So it keeps the payments affordable for their client, as well is that the client is going to be on a declining balance. So they're going to be paying down the principal as they carry the land. So the longer they carry that land loan and that land, the more equity they're gaining in that land. So when they do want to go build or whatever, they have more equity to go towards their down payment. For example, like construction. Okay. Any questions? Next slide. So this kind of ties into the last slide. So what I'm seeing this year, for the last number of years, I've sort of focused a lot on construction mortgages, but this year in particular, there's a lot more construction mortgages. I think that kind of ties into the supply and demand issues in the housing market right now. Clients getting outbid and getting frustrated, or turning to looking to build. And that's sort of in the construction draw mortgage side. But the first type of construction mortgage we do would be like a turnkey. So for example, maybe like in the West Bedford area, there's certain builders in that area that have a project or a condo development. We do turnkeys that we can hold rates up to 24 months. So we have builder packages, and for clients that are looking to build, they might not be closing within that 130-day time frame, then we can hold the rate for up to 24 months. That's a really big feature in today's market with that increasing rate environment we're seeing. It provides the client with some certainty at a sort of a worst case scenario, what their rate is going to be. Let's say if it's 12 months or 24 months when their home is built, what the rate payment will be. Under that program, the client has what's called a partial look-back feature. So when they do get to that completion date on their home purchase, they can take the lower of the market rate at the time that they're closing, or the what we call the cap rate, or the builder rate that we've held for them for either, say, up to 24 months. As well, under that program, we offer firm approval. So at the time of application, we have a firm approval on hand.
Can you say that last thing again, so when it's finished, they
Yep.
can choose the rate they chose or the rate it is
At the time.
now?
Right.
So which one is lower?
Exactly. So let's just say, for example, builder rate today for 24 months might be 4%.
Okay.
And let's say in 24 months from now, rates, the market rate at that time is 3.8%. They can take the 3.8.
Or if it's 5, then it can.
Yeah, exactly. Construction mortgages.
Wait a minute.
So construction mortgages. So again, that ties in, like I was saying, to some of the land financing that we do. But if you are coming across clients that maybe you help them secure land, we also do construction mortgages, and try to be as unbiased as possible. But I candidly, I think that we have the best construction draw mortgage program in the marketplace. So we do construction draw mortgages on self builds, and on contract builds. So essentially, what we do is we have a mortgage. We authorize the client for a certain mortgage amount that will draw down through the course of construction. We can do up to a maximum of 5 draws on a construction mortgage. One of the unique things that we have at BMO for our construction mortgage is that we will finance the build at the rate of the mortgage. So we lock the rate in up front, and we can finance at the rate of the mortgage. Versus, I know some lenders will offer like an open product, or maybe maybe an open variable or an open term product, and they can't lock the rate into the end of the project. That is really key in today's rate environment. Again, where we've offered the clients a little more stability or certainty up front for the mortgage. And during the build, they don't pay any mortgage payments on the mortgage. They service the interest on the mortgage based on the balance outstanding at the time. So it allows them to maybe stay in the home that they're at right now, or maybe the rental they're at right now, and only to service the interest on the mortgage at the time. I touched on the competitive rates, and some lenders don't offer those rates that we have. So yeah, it's a fantastic program. So if you do have clients that are looking to build, obviously I think we're a great option for them. Next one, yeah. Modular home financing. So different than what Mike touched on MOALs, but modular, again, we're seeing, I think, this grow in popularity as well. So modular homes, for example, a home that is sort of built a bit off-site, shipped to the home, and then the finished work completed on site. We do finance those projects as well. We can finance those as little as 5% down, like a regular home. So essentially, we're treating that like a regular stick-built home or regular resale home. The way we sort of finance those is we'll finance it usually in 2 draws. So at the time of delivery of the home, it's set up on site. We'll do the first draw, and then the completion draw once the finished work is done. What we've found is that there are some lenders, a lot of them, what we call monoline lenders for sure, don't finance these. Yeah, I think we've carved out a bit of a niche in that space. Again, competitive rates. So the same regular mortgage rates or conventional mortgage rates apply for these properties. What we see a lot of time, or most of the time, clients looking to do a modular home is they already own their land. That maybe they're running into issues with some builders sourcing a conventional type builder to do a stick-built home, given the demand, and the modular space has become a good option for them. So they can use their equity in the land essentially as their down payment. So if they have land worth $75,000, that could service as all of their down payment. They wouldn't have to have any cash injection into the project. Refinances, so all lenders do refinances. So just to quickly touch on this, essentially what we do is we do 80% of the value of the home. We're seeing a lot of that this year, obviously. People have gained a lot of wealth in the last year, given the market. They're taking advantage to either invest or consolidate debt. The average cost to do a refinance, we charge a flat appraisal fee. Oftentimes appraisers are charging a lot more than $300, but the bank is only charging a flat $300 for those appraisal fees. I think I actually saw an appraisal come in yesterday that the cost was over $1,200. Fct fees or legal fee taxes in. Fct fees would be about $565. Some clients do have a lawyer that they use. What we see on average is Fct is maybe a bit more cost effective than maybe what a lawyer could do. So it's a great option for the client to control their costs and keep it all in-house and sign at one place. And then discharge fee typically ranges from $300 to $400, depending on the lender. So on average, total cost, it's about $1,200-ish plus if there's a penalty associated with breaking that mortgage. I will quickly touch on what the bank has done a really good job at is running seasonal promotions to have cash options to cover some of those fees. So I think pretty much every sort of what we call season or quarter, there's a new promo that the bank has launched to cover those fees. I think the current one right now is up to $3,000, depending on mortgage amount. So they sort of tier it. The lowest tier is maybe $1,200, and then the highest tier is $3,035 or something like that. So what we're seeing right now, why are people refinancing? Again, consolidate debt. That's a great time to do it, given where the rates are. Even though rates are rising, they're still historically low. Investment purposes, it's again, same thing. It's a great tax vehicle to use the equity in your home and write off the interest if you're looking to invest. Mike did a great job touching on the down payment to buy a rental property or a cottage. We see a lot of that as well. A lot of clients tapping the equity. Either they're trying to grow their real estate portfolio for retirement purposes, or simply to gain a secondary home, which has really gained in popularity as well with COVID. Less people traveling, more people staying local.
And one thing I'll touch on that is we'll do the analysis for your clients too, right? So you might say, okay, Mike, I have a client that's interested in looking at refinancing. Right, they could have $30,000 on a line of credit they're paying 7% on. They could have 20 grand on a credit card they're paying 21% on, for example. Rates are that high on the unsecured products. So we'll kind of say, okay, here's what you're paying for interest all in with your mortgage, with your line of credit, with your credit cards. Maybe there's a vehicle you want to consolidate. could be some other debts we want to. So we'll do the analysis for your clients and say, here's probably why I would do it, or I wouldn't do it. But I would do it because of this. Save you a ton of cash flow. We can save you $1,000 or $2,000 a month. Cash flow, save you $500 in interest, whatever it might be. So it does make sense right now for a lot of people. And I mean, it's kind of hard to say lock in a low rate of 3.8 right now, for example, but from what we're hearing, Andrew talked about the rate market, where they're going, it's not selling. So, but this is probably last year about 1.7 on 1.8 on fixed, so it's a little bit different.
And then the last one is renovations. Again, I'm sure Mike's come across this as well, and maybe you guys as well. Clients are looking to maybe move and buy, and they've been open a dozen times and they're tired of it, and they're just going to tap the equity in their home and tailor it to their needs at the time. So whether it be kitchen, bath, whatever it might be, or exterior. So we're doing a lot of refinances for renovation purposes as well. Next slide. Rate environment. That's the hot topic right now. Like Mike had said as well, rates are going up. It's not a matter of if anymore. It's a matter of how much. And the big question is why. I think if you've turned on the news at all, the inflation is the big issue right now. So the Bank of Canada is one tool that they have to control inflation is by managing interest rates. As inflation increases, Bank of Canada typically will increase their rates to cool down the economy, essentially is what they're doing. So that's what they're doing, and that's why rates have been rising, or one of the reasons why rates have been rising. I think the Bank of Canada has what's called a monetary policy announcement on Wednesday, tomorrow I think it is, and it's highly anticipated it's going to be a 50 basis point increase to what's called the overnight lending rate. So that will tie into bank prime rates. So that's likely to happen. I've heard other scenarios where they might go higher than that, but we'll wait and see. But that's likely to happen tomorrow. So as well, fixed rates. So there's two types of rates, fixed to variable essentially. Fixed rates are rising, and like Mike had said as well, we get very, very short notice on fixed rates. When they move fast.
24 hours.
Yeah, so without getting too complex, fixed rates are tied into sort of what's called the bond market, and what we're seeing is bond yields are rising, so fixed rates are rising. I would not be shocked if we see another increase this week. We saw one on Friday last week. I would be shocked to see another one. So again, tying back to the pre-approvals, highly encourage your clients to hold the rate. It costs them nothing to hold the rate, so I would encourage all your clients to do that. In terms of variable rates, so that kind of ties into point number one. The variable rates ties into what the Bank of Canada does, because the bank prime rate is tied into the Bank of Canada overnight lending rate. BMO released a forecast for rates this year, and they forecast 150 basis points increase to the Bank of Canada rate. So today, the bank prime rate is 2.7%. So if that forecast holds true, by the end of this calendar year, that prime rate of 2.7 will be 150 basis points higher. So what's that, 4.2? Okay, so again, it's good.
So if you're in variable yourself, your rate will go up.
It will go up as well. 2023 forecast is right now. This is subject obviously to change because the market is so fluid. There's lots going on in the world with the war in Ukraine, for example, and still COVID. The forecast next year is another 50 basis point increase. So this is the trend. Now, I don't think that's certainly not forever. I think from what I read is from there it starts to maybe level off. And then what we've seen with COVID, things change on a dime. So it's really hard to know. But again, at the end of the day, rates are going. The big question that we're all asking ourselves, and I know you guys are probably asking with that information, if rates go higher, it means qualifying rates for clients goes up, monthly payment goes up, affordability is challenged even more so. Clients are feeling more stressed. What is the impact of that? Let's go to another hot button topic. Who knows what it's going to do? Maybe we'll scale things back around here. I've talked to some other people within the bank, and I know some colleagues in the Quebec market, Montreal, and they've already seen some cooling in that market. So
what that means is we have to qualify the lenders off either the higher of your rate plus 2 points, or the actual Bank of Canada qualifying rate of 5.25, for example. So the last 3 years or 2 years ago, it's always been 5.25 is what we qualify. the stress test. Now, if your client's getting 3.84, 3.84 plus 2 is 5.84. So now the new stress test for this client individually is 5.84, which is going to reduce definitely, as Andrew mentioned, their buying power, their affordability. Right. So that's one thing that the qualifying rate we're not using as much, 5.25. It's getting up into close to the 6s.
Well, hopefully we won't see the 80s again.
No,
Yeah, I don't think it would be.
Yeah, and that's
19
not-
to 20%.
Yeah, that's not a scare, and that's definitely not a scare tactic at all. I don't think we will, but I think it's been long overdue. Rates have been artificially low, and it's time to get back to a bit more normal rates. I've been in the business for 15 years at BMO and 20 years overall, and I have old marketing material that I was sending out some people on the team as a joke, and 499. I was like, at some point, this is going to look like a good deal again. So
Yeah,
I think it's just going to go back to that.
For sure. Next. Any questions on the rate environment? You guys are good? Yeah.
So additional unique programs that BMO has. I'll quickly touch on each because I could be here all day if I talk about each one. BMO Savers Advantage program. So BMO, the last couple of years, launched a program for, I guess, higher net worth clients that maybe don't have as much income but have a lot of savings, and they use that to live. So BMO has a program for those clients that we can rely on the balance of the assets to offset their obligations, essentially. So we don't really have to go by standard debt servicing guidelines. That program requires the client to have 20% down, so you can't do like a CMHC insured mortgage on that. It's been a real winner at BMO over the last couple of years. We've seen that really grow. Program number 2 is the Medical and Dental New Professional Program. So that program is designed for new medical professionals or dental professionals that may be, for example, in their last 2 years of their residency, that essentially we develop a stated income for their field. So for a dentist, it's a certain amount for a dentist. And then on the medical side, if it's like, for example, a general practitioner, I think it's 2.25 a year. If it's a specialized field, radiologist or something like that, I think it's 3.25, I think. So essentially it's like a stated income program for new medical professionals, a dental program, or new dental professionals, that we can essentially use a stated income amount to service the obligations. That program is available to either clients who have 20% down or assuming C insured mortgage at 10% down. So, and one of the unique things that under that program is clients can use their medical line of credit for down payment purposes. It has to be a medical line of credit. BMO Self-Starter Program. So the Self-Starter Program is like, again, it's a stated income program for newly self-employed. They have to be self-employed for a minimum of 2 years, but no longer than 5 years. So as we know, many self-employed, as they get up and running, their expenses are a little higher. They manage their bottom lines a little bit more for tax purposes. However, the reality of it is that their ability to service doesn't really align with what their tax return might show. So depending on their field of work, we can sort of estimate an income for that person. That program is available for through our mortgage insurer. So it's not under the 20% down, it's a 10% down program. And so
I don't believe it's available for commissioned employees.
And it's not, yes, so it's not available for commissioned employees. Okay. And then not necessarily a program, the last one, debt servicing, and Mike kind of touched on this earlier, that again, trying to be as unbiased as possible, but what I find at BMO is as much as possible as a bank, we do apply some level of common sense. And I think our credit department is great with developing scenarios, or policies are great with developing scenarios that are flexible to create sort of what if type scenarios to push the boundaries on debt servicing. I think we're just a little less rigid than some of the other big banks and lenders on that. And I think that's a real competitive advantage that we have. Yeah. And yeah, that's it.
That's 2 minutes over.
And we started late, so it's all good.
Yeah, and we had interruptions.
Yeah. So that's kind of everything. We'll get that sent out to you guys as well. Right to be in your box
Yeah, I got it there,
But if you guys have any questions, like just call Andrew and I directly. We can answer anything you might have, any specific client scenarios that you're going through, or just curious about anything. Any things that you guys are going through that we definitely didn't touch on here, right? We could stand here for 2 days if you wanted and keep going on and on. So we just kind of picked a few topics there for you guys that may impact what you're seeing, what you're going through a little bit. So do you have any overall financing questions that maybe you're dealing with right now that if we don't know the answer, we'll get you the answer right away, but is there anything on with the Zoom guys or anything with you guys here that?
Hello guys, I have a question. Is there anything like if someone doesn't have the income or doesn't have employment, so if he puts up the 35% down, then there is a sure mortgage fine?
Is that anybody who doesn't have employment but has 35% down, more like a sort of a
It's like an equity program.
equity program? Is that kind of what you're asking?
Yes.
We don't. I think years ago we used to, and we sort of moved out of that space. And with some of the new programs that I talked about, we sort of gravitated a bit back into the stated income space. But if there's no employment, then we're a little challenged. Possibly they could fit under a Savers Advantage program where they might have a lot of assets, liquid assets. But if they don't, they have no employment, then we're not operating in that space right now.
What about if someone were to move here and they've started a new job?
Mhm.
Would you need them to work at that job for a specific time, or?
So that one's it depends, because everybody's situation is unique. It could depend on if it's an insured mortgage or not an insured mortgage. What do we have to confirm their new employment? So there's a few scenarios there. I would encourage you, if you come across that, to get it in front of us. So there's no, I guess, one size fits all answer for that question. Everybody's situation is a little unique.
Exactly.
Yeah, but there are ways where we have done that for sure.
One thing I see all the time is obviously with a new job, you might have with the government, you have a 12-month probationary period.
Yes.
Some places have 3 months, 6 months, right? So if we're trying, as like Andrew said, get it in front of us, because let's say you have a 6-month probationary period and you're 2 or 3 months into it. Okay, but what we'll look at, because we always have tried to mitigate credit, right? Picture yourself being a credit officer, we got to make you comfortable with the deal. So let's say it could be a government position, or let's say you're, I don't know, electrician or something here, and you're with a company for 3 months, but you're an electrician out west for 20 years, right? You've been doing this. We can kind of mitigate around that, depends if it's insured or conventional, but we can get credit a little bit more comfortable with the deal. Saying client, exact same industry, profession as previous, that'll help them. It's not a totally new industry and a new job for them. Essentially, it's almost the same job, but a different company. That'll help us kind of mitigate a little bit around the probationary period. Yeah, we'll always ask the exception, right? So there's always exceptions that we're willing to make. Obviously, more exceptions we can do with 20% down, because CMHC, the default insurers, are not involved in the deal. But like I said, we can try to be as lenient as possible, and all we can do is just ask credit. So just as long as your clients are upfront and give us everything upfront, then we'll ask credit for the exceptions, and hopefully they give to us. I'll always keep asking. I'll put the face. I'm stubborn like that. Yeah, exactly. Yeah. Sure. Any other questions at all?
Okay, so if someone has started a new job and it's been 3 months he's in job, so will he able to apply for mortgage?
3 months seasonal?
3 months, like he has a full-time job, but he's being 3 months in a job, new job. So
Yeah, you mean, like I said, it goes back to, the way I'd answer that question is go back to what the probationary period is, right? So we'll want to see that original offer letter, right? Or an employment letter. So we need 2 verifications for employment. One's going to be pay stub, and the other is going to be in a new situation is going to be, we're going to want to see a job letter confirming kind of what that salary is to match the pay stub plus the probationary period. And we can, definitely after 3 months, we can get around that. Like the
if he doesn't have probation,
what's that?
Okay, if he doesn't have probation period, like if his employer is like, he's not having any probation period, he's full-time employed, he's being in job for 2 months, so he still can consider?
Yeah, 100%. Especially if there's no probation period, he's full-time, and the letter confirms that he's full-time, he or she's full-time salaried. Oh yeah, 100%, absolutely. As long as it meets the other criteria of debt servicing in line and credit's okay and things like that, but definitely no issue at all. One thing we will have to ask, if it's less than 2 years employment, we'll have to find out where the previous employer was and just put that in the file. But yeah, that's not an issue at all.
One last question.
Yep.
So can you give a quick idea, like just to make more viable for us? Like if someone asks, like he has 100,000 income, so how much? How the calculation should be, like the estimate? How much multiplication it should be to the income?
So like if they make 100 grand, how much can they be approved for? Is that?
Just the idea, just if we want to give an idea,
Yeah,
just
the big thing. So that falls under debt servicing, right? So the big thing is going to be is what their current liabilities are, right? So everybody's different. You could have one person that makes 100,000 that has everything paid off, or another person that has a car payment, a boat payment, a truck payment, $20,000 on a MasterCard. So you can't say everybody's the same making 100,000 because people can be very different. I might be able to prove someone making 100,000 for a $650,000 home, but then I also might another person make 100 grand for $250,000 home. It all depends what their outside liabilities are. So that's what I'll do a pre-approval for, just to let you know the max. So it's good for me just to take a look at their credit bureau and see what liabilities they have that I have to factor into debt servicing.
if someone has 100,000, you mean if he doesn't have a liability, he can go for 650 as well?
I just threw that out kind of as an example, right? But the debt servicing, like if you're doing less than 20% down, you gotta have, there's two different debt servicings. There's TDS, total debt servicing, and GDS, which is your housing expenses. So your housing expenses are gonna have to be at 39% as a maximum. And then your total debt servicing is a maximum of 44%. So we use gross income. So for example, not to get too far down with you, but the way it works for us, if a guy or girl makes $100,000, we divide that by 12. So whatever that is, 8,800 or 8,500, give or take, multiply that by 44%. And all their liabilities have to fall under that 44% of what their monthly gross income is, right? So now it's getting a little more challenging, as we mentioned earlier, because we're qualifying off a much higher rate, right? We're qualifying now almost off 6%, which instead of 5.25, so that's reducing the buying power. But yeah, and then you have to look at, the big one is GDS, which is your housing, which is your principal, interest, and taxes, and heat. So whatever, if it's a mortgage payment of if it's a mortgage of $400,000, what is that over 25 years at 5.85%, for example, plus your taxes, plus your heat? That's your GDS, and then the TDS is anything else above that, car payments, MasterCard, things like that. Yeah, but you can give me a call, and I can kind of take you a little bit further down the debt servicing road, how that works.
Please stop your number as well. Yeah. And the business income, like business loan also, in fact, the mortgage, housing mortgage, like if someone has the loan on the business, will it impact on the housing mortgage as well?
So it's just if they have, like if they're self-employed, if they have business income, is that what you mean? Or what? I don't fully understand the question.
Yeah, if someone is self-employed as well and he's doing business also.
Yeah.
He's employed also. Yeah. Sorry.
Yeah, so we can do that. You know what I mean? So we'll take the standard employment income. So if they're making $100,000 based on salary, and we can confirm all that, and they have essentially called a side business, for lack of better words. Let's say they're a real estate agent on the side as well. We would take right. We would take a 2-year average of that. Right, so we'll take the salaried income plus the 2-year average of the net income that's showing on a sole proprietor. So if you're not incorporated, we can gross that net income up 15%. Or if you're incorporated, we're just going to take a 2-year average of the salary you pay yourself or dividends. Yeah, so there's kind of two streams of income there we could add together.
Okay.
Yeah.
I was just asking, like, if we have side business and we have loan on the business on the business, so will it impact my housing mortgage also?
If it's personally guaranteed and it shows up in your credit bureau, then yes, it will. We have to use that liability, for example. Yeah.
Okay.
Good questions, though. Any other questions at all? Good. Perfect. Awesome. Well, thanks for having us in, everybody. Thanks for teeing it up.
Yeah.
Appreciate it.